You're fired. You gotta pick sides. If you're not on mine, you're gone.
Public execution.
Get with it or get people.
So you're firing me too?
No, he fired you. I'm seconding it.
One would do well to go with whoever can get the best kill.
How can you make a lot of money during earnings season? Well, we will discuss this and much more as we analyze Billion Season 4, Episode 1, based on my work experience at the top hedge funds in the world, my work experience starting a hedge fund, and my work experience at Goldman Sachs. Now, please like, comment, and subscribe, and stick around, because at the end of this episode, we will grade the episode for Wall Street realism with a buy, hold, or sell rating.
Teva's about to announce. You poised, dollar bill?
All right, Captain.
So it's earnings season, which is the most stressful part of working at a hedge fund, and companies like pharmaceutical giant Teva report earnings 4 times per year. Now, why do stocks move a lot after hours or before the market opens during earnings seasons? And how can you make money during earnings? So let's use Teva, as Bobby mentioned, to trader dollar bill as an example of a stock moving a lot. And what I'm about to show you is exactly what hedge funds do during earnings season. Now, on November 5th, 2025, Teva issued their 8K earnings press release on SEC.gov. And the second it hits SEC.gov, hedge fund analysts update their financial models. Now, in this case, we see that the non-GAAP earnings per share was 78 cents for the quarter versus Wall Street estimates of 67 cents. And this means that Teva beat by about 16%. As a result, the stock should jump immediately about 16%. Why? Because when hedge fund analysts take the financial statements in this press release and update their financial models, their EPS estimates in the future could jump by 16% as well. And analysts usually base target prices on a PE-based target price, with the E in PE being earnings per share. Now, if Teva missed by 16%, then the stock should drop by about 16%. However, the stock actually did not go up 16%, it went up 20%. And the reason was because after earnings, JP Morgan increased their target price, and because some short sellers covered due to the fact that the company's turnaround was working. Now, how can you make money from this? Well, if you update your financial model the second that the company reports earnings, and your EPS estimates go up or down much more in percent terms than what is reflected in the stock move, you can profit from this. And please don't ever assume that the markets are efficient.
If America Mobile gets whacked, the peso goes with it, Ev.
I'm ever ready.
So America Mobile is a massive Mexican telco company, and acts as saying if America Mobile reports terrible earnings and falls sharply, investors may conclude that the Mexican economy is weaker than expected, and the Mexican peso could weaken as investors pull money out of Mexico. Therefore, Axe might consider shorting the Mexican peso if he believes investors will view weak American mobile results as a sign of a broader economic weakness in Mexico. Now, Axe is thinking one level deeper than the obvious trade here. And the lesson is that the first order trade, meaning American Mobile, might be crowded and already priced in. And the real money can be in the second and third order effects. And this is a recurring theme throughout Billions and mirrors the approach used by many top hedge funds.
Hey, Rudy, where are you landing on Rio?
So Axe is asking cyclicals analyst Rudy, after all your research, what's your call on iron ore mining giant Rio Tinto, and how should we trade it, meaning long or short into earnings?
I'm seeing weakness in Australian ore, so...
You're the only weakness I'm seeing.
So Rudy is implying that weak iron ore prices could pressure Rio Tinto's earnings, which would support a bearish view on the stock. And trader Bonnie is not interested in hearing facts. She wants a trade recommendation. And at hedge funds, analysts get paid to process information and then make a call.
Wait, what? Over in the kitchen before the open, you said they were expanding their rail capacity.
Yeah,
So I thought that must be expanding their capex, so we'll be down for
that
a
was a
quarter or two.
mistake thinking.
So here is why Bobby Axelrod is frustrated. Rudy is telling him 2 different stories. First, iron ore prices are weak, which is bearish for Rio Tinto. Then Rudy says Rio is expanding rail capacity, which suggests that management expects future demand to increase. And so Axe doesn't want data points. He wants a conclusion, meaning long or short the stock.
Hey, what's the rumpus?
Nothing.
I want you two in sync like incestuous ice dancers. So give, Bonnie.
They're expecting shipments of 360 million tons. The information is out there.
So Rudy, the analyst, is supposed to know this, as Rio likely mentioned that on their last earnings call or in a public setting. Now, in reality, this confrontation would usually happen behind closed doors. And great hedge funds are collaborative because the best investment ideas often come from multiple people connecting the dots together.
Do you know why Ovi scores so much? Because Backstrom shares the puck. So I fire him and he never f***s up again. Right, Rudy?
That's right, Axe.
So hedge funds love hiring the best athletes as they deal with pressure and they are team players. And a quote often used in hedge funds is from Wayne Gretzky, who was successful not because he skates where the puck is, but he skates where the puck is going to be. And for stocks, you need to invest in stocks that investors are going to like. And I want you to think long-term from a game theory perspective in order to make money. Now, what is Axe going to do with Rudy?
And you signed your non-compete, didn't you?
Of course.
Good. Rudy, you're fired.
So what Billions gets wrong is that this would never happen publicly. When somebody is let go at a hedge fund, confidentiality matters. And the discussion almost always takes place privately with HR present. And great managers praise in public and only criticize in private. And severance varies by firm, seniority and circumstances. Now, separately, I believe in hiring slowly and firing quickly. Now, it feels awful, of course, the first time you let somebody go, and here's how to do it. On a Monday and never a Friday, you want to call the person into your office with HR present and say this if true. While you've worked here, you did a good job at X, Y, and Z. However, given the suboptimal performance on whatever they did, we have to let you go. Then you say nothing and you wait for them to respond. And then HR will explain any severance benefits, continuation, and transition support that may be available. Now, if you want, you can also say that you'll be a reference for the good work they did with respect to X, Y, and Z, for example. Now, it wasn't just poor performance that got Rudy fired.
For misreading Bonnie's information?
That, and for fraternizing with our sworn enemies. Taylor Mason Capital Picnic.
So never post on social media that you're friends with people that quit your company. And please assume that all of your social media posts will be read by current and future employers as well. Now, we've not given offers to people in the past that have had brutal social media posts, so please delete them.
Public execution.
This is a new day for Axe Cap. So we will all share our information or we won't be a part of it. Get with it or get people.
So you're firing me too?
No, he fired you. I'm seconding it.
So you need to share information at a hedge fund. For example, if you're the semiconductor analyst and you cover NVIDIA and you see that deferred revenue is down, you've got to tell the analyst that covers data center and AI companies this data point. If you hoard information, you aren't a team player and you won't last long.
The new beefed up non-competes, ready to be signed.
It better be ironclad.
So when you join any company, please hire a lawyer to read your contract before signing it to make sure that you can leave to work for a competitor, and more importantly, that your compensation is clearly documented. Now, I've seen hedge funds and venture capital firms document bonus terms without a deadline date, meaning they can literally give you your bonus in 20 years or longer. Now, hedge funds usually discuss investment ideas in their morning meetings in a conference room before the market opens, which looks like this from episode 2.
We are up 32% year to date, and we are open to all money-making ideas. Longs, shorts, sells, covers, all alpha welcome.
The choppy waters out there, perfect.
Now, during the morning meetings, the portfolio manager, Bobby Axelrod, and his sidekick, Wags, what they do is they ask the other portfolio managers and analysts sitting at the table here to pitch their best money-making ideas. Yes, they're very rude with employees, but the employees don't care, as you can make 7 or 8 figures per year, although it's hell, you do age a lot in that year. Now, each person at this table is responsible for investment ideas in stocks in different sectors, like technology stocks, but not Apple, on the long side, which we'll talk about in a minute. And the analysts and the portfolio managers at this table are also responsible for other sectors like retail stocks, industrials, banks, commodities, healthcare stocks as well.
Why are we still tied up in those hospitals?
Baby boomers, they're getting old, so they're getting sick. When the group reports patient volumes, it's going to overshoot street expectations. We're talking 10% move.
So when she says street expectations, she means that the company's quarterly revenue and earnings results will beat the average Wall Street analyst's expectations, which means a stock will likely go up similar to what we discussed with Teva.
Our investors pay us a 3% management fee and 30% of their profits, and you want me to tell them we're buying some Apple?
Sorry, Axe.
This is accurate. As crazy as this sounds, pitching Apple as a long idea over the past 10 or so years is really frowned upon by sophisticated billionaire hedge fund owners, even though the trade made people a fortune. And the reason is that everybody has loved Apple for the past 10 or so years, and it's an easy stock to pitch as a long. And these analysts and portfolio managers are paid to search for investment ideas that are not obvious. Now, if he pitched Apple as a short idea because of a thesis that Apple is potentially having supplier inventory issues or riots in China and it's overowned and the market cap is way over $4 trillion and the stock won't go up in positive news, then Bobby Axelrod would respect that much more. And you'll notice here that Axelrod said our investors pay a 3 and 30% fee. Now, what he means by this is that hedge funds get paid two different ways. One is based on an annual management fee. So the annual management fee that Axe charges is 3%, meaning if he manages $1 billion, he gets 3% of $1 billion, which is $30 million, as an annual fee to pay for salaries, travel, back office, etc. The second and biggest way hedge funds make money is from the annual performance fee, which is 30% for Axe. So if his $1 billion fund, for example, is up 100% from $1 billion to $2 billion, then his annual performance fee is 30% of the $1 billion in profits, which is $300 million. It's a lot, and that explains the 3 and 30 fees. Now, if a hedge fund loses money in a year, they cannot make that performance fee back the next year until they make that money back for their investors. And this is called a high water mark. Now, longs are always much easier to pitch than shorts.
What happened on Eureka Transship? You knew they were going to whiff their numbers. Why didn't you bang the short harder? You left 5% on the table.
I thought they were going to whiff, but I didn't know.
You're such a...
So with a long idea, the most you can lose is 100% if, God forbid, the stock goes to zero. On the other hand, with a short idea, which means betting a stock will go down, it can theoretically go up a near infinite amount. And so your losses can be massive, which is why it's so hard to have conviction when deciding how big of a short position you should have on. And we all saw what happened with GameStop as well as AMC. Let's talk about the best hedge fund investors now.
You sure you don't want to come along and help me deal with the Sovereign Wealth Fund?
This is my sovereign wealth fund.
You really sure you want me to deal with the royals? Competition is probably sending their top dog.
Oh, believe me, they're not sitting down with Taylor.
So the best investors to get are pension funds, endowments, and sovereign wealth funds, as they're very long-term focus and sticky money. Now, here are some examples of the largest country-specific sovereign wealth funds that invest in alternative assets like hedge funds. Now, Axe is arrogant in that he thinks the sovereign wealth fund won't meet with Taylor, who quit Axe Capital and started a competing hedge fund in the previous episode. And Taylor is wearing a disguise to meet with a sovereign wealth fund. And Axe arrogantly refuses to meet with the Middle Eastern Sovereign Wealth Fund.
And the sovereign money is pledged to us already. This is just about setting terms.
But that's the hard part. Nobody's paying full freight anymore.
Wags, it's bad enough that we had to go to 2 and 20. We got to make our stand there. We might as well be running a mutual fund. You go, deliver this message.
So Axe hates the fact that the only way to get this investor is through reduced 2 and 20 fees. And you'll notice that he makes fun of mutual funds, which suck as investments and often massively underperform lower fee-based ETFs. And one popular long-term ETF that I own, do your research first, is Vanguard's S&P 500 ETF, ticker VOO, which has a very low expense ratio and tends to be tax efficient because portfolio turnover is relatively low. And Axe's right-hand man arrogantly meets with the sovereign wealth fund himself here.
No one enjoys your company more than I do.
Oh, I can supply you with the names of a couple gals who might give you a run for your money on that.
The Sheikh would prefer, and frankly is in the habit of sitting with the decision maker, with Mr. Axelrod.
Think of me as that decision maker. I speak for him.
So there's no way that he would arrogantly sit and talk like that. Now, when I've gone to Abu Dhabi and Dubai to raise millions, I research cross-cultural greetings and much more, and my Egyptian and Lebanese roots help me a lot with that too. Now, I'm gonna be transparent. After 9/11, it was hard. Given my last name, for some reason, I was on the no-fly list when I worked at Goldman Sachs in New York. And I would go to LaGuardia, and they would do really, really thorough questioning and searches, advanced searches on me. And in Germany, when I flew in to meet the CEO of SAP, I lost it, man. When a customs official at the airport there in Frankfurt asked me my ethnic heritage back then. Now, I'm proud of my heritage, and I recommend that you all leverage your heritage to get investors and networking meetings. Let's get back to the episode where Wags is digging his own grave here.
To Bobby Axelrod, fees are religion and money is his god. This makes him the perfect shepherd for you in the material world. And at least when you pray to his god, you get another Bentley out of it.
So what happened in this episode was Wags got kidnapped after this meeting, which is a far-fetched and is similar to the Saudi kidnapping event. But stressing that money is your god is why so many people are depressed on Wall Street, as everybody compares themselves to those that make more. Now, here Taylor meets and wins the investment from this sovereign wealth fund.
You see, falcons mate for life, as humans do.
One would do well to go with whoever can get the best kill.
Let us take some tea with the sheikh.
Now, not only does Taylor beat Axe and get his sovereign wealth fund, but Taylor also tries next to recruit Mick Danzig, who used to work for Axe.
There are things they were comfortable with at Axe Camp that we will never do here.
We will do it the right way this time, man. You know how loyal I was to Axe? This is why I left him to come here, and why you should be here too. We need folks right now. We're desperate.
Now, Trader Maffei saying we're desperate is never used as a sales pitch, or you end up only hiring B players.
Where are the applied math wizards, the financial engineers? Do I have to go to an MIT job fair?
I'm trying. Wall Street's had some other luster knocked off.
Find me people with no fear, like Sarah.
Now, Taylor Mason Capital can't seem to find the right people to hire because of this.
We've succeeded in keeping the best applicants away. I took care of the headhunter.
Now, of course, bribes like this are great drama, but this doesn't happen in real life. But competing for talent with higher offers certainly does.
It's frustrating, Taylor, but they did bring in Mick Danzig. Want to hire him?
Well, scoop him up. Overpay him.
You want Danzig that much?
What I want that much is for Taylor to have nothing.
So Mick Danzig was a big moneymaker for Axe. Now, let's revisit this meeting the on-site coach Wendy here had with Danzig from the pilot when talking about his bonus.
7.2 million. 7.2 million. Feel that.
So hedge fund employees make a percent of how much money they make the firm in a given year. Now, I've worked with people at hedge funds that have made hundreds of millions of dollars and certainly more than $7 million. And a portfolio manager usually gets paid half of the incentive fee. So if Danzig here made the firm $100 million, then a typical large hedge fund would keep 20% of that, meaning 20 million bucks. And the portfolio manager would get half of that, meaning 10 million bucks.
I just lost my mojo somewhere along the line. It's gone. And you're Mrs. Mojo, so I booked the appointment.
It's Dr. Mojo.
Now, this scene is fascinating. And there's a psychiatrist or coach on site at this hedge fund, and that's actually normal for massive hedge funds. Now, I've worked at some of the biggest hedge funds in the world where they've actually had psychiatrists on site. And what they do is this. They talk to you about your P&L, meaning your profit and loss statement. And if you want to approach them to talk about your performance, they're always there as well. Now, Julian Robertson, who basically pioneered the whole hedge fund industry in New York City back in the 1980s, he started something called Tiger, a big hedge fund. And a lot of great hedge funds came out of Tiger, and they're called Tiger Cubs. But he almost always had a psychiatrist on site as well to do this sort of thing. And I once worked at a hedge fund in New York City where there were a couple of very abrasive portfolio managers that used to fight all the time. And they forced all of us in the fund to go through this counseling as a group, which was really painful.
And you're ignoring the quiet one inside, telling you where the alpha is.
So alpha represents how much you outperform the stock market by. So in a lot of mutual funds, you get paid on how much you outperform the stock market by. So if your benchmark you're being compared to in a mutual fund is the S&P 500, and the S&P 500 is up 10% and you're up 11%, then you generated 1% or 100 basis points of alpha. Now with hedge funds, it's a meritocracy. You eat what you kill. So you get paid based on how much money you make the firm, unlike at mutual funds. Now let's talk about grading of this episode for Wall Street Realism with a buy, hold, or sell rating. The episode did a superb job of showing how hedge funds prepare for earnings season and how the best hedge funds stress collaboration, meaning sharing ideas. However, the episode was unrealistic in that there's no way that they would bribe headhunters to do a crappy job, and there's no way that Wags would be so disrespectful to sovereign wealth funds and get kidnapped. As a result, I'm going to give this episode a cell rating, as much as I love the series. Please like, comment, and subscribe, and I will see you in my next reaction video, which is Billion Season 4, Episode 2. I've now completed 37 review videos for the 12 episodes per year of Seasons 1, 2, and 3, and the first episode of Season 4. Please see the link in the description to access all these reviews and my reviews on many finance movies, including The Big Short, Wall Street Margin Call, and many others. I hope you enjoy watching these as much as I do creating them. Thank you.